Hello, everybody. My name is Colton Keller. I'm going to be going over the FPL case, specifically the dividend policy with it. So what is FPL? FPL is the largest electric utility in all of Florida, and they had a net income of $513 million in 1993. They served over 3.4 million customers. The dividend per share is 2.48, which means a 90% payout ratio, which is very high in regards to everybody else in this industry, but we'll get more into that later. And their stock is known for stability. Over the years, they've always continuously grown and grown and grown. This is why a lot of people view it as such a great investment. We'll also get into that later as well. So the objective of this presentation is to evaluate FPL's dividend policy, go over if they should increase, maintain, or lower its dividend, and analyze FPL's next steps. This basically means what FPL should do to maintain their shareholder confidence while retaining more money, because that's where the main problem is right now and lies. But we're going to get into that and figure out how to solve that. So to start off, why do firms pay dividends? The purpose is to reward shareholders. To put this in an easier way, if you are investing in a company and you're retaining dividends each quarter or whatever it is, it shows that that company is very confident in themselves to give you their earnings and rewarding the shareholder to gain more confidence. So that brings me into the advantages now. Doing this builds trust, loyalty, and reflects confidence in the company itself. The disadvantages to this are low retained earnings, limits their reinvestment, and can create financial trouble. And those disadvantages are kind of what FPL is facing right now, and we're really going to dive into that and then give a solution. So FPL's dividend payout ratio. The current payout ratio is 90%. Then a positive from this, if they've maintained a 47-year streak of continuously increasing dividends. Negatives is that it restricts retained earnings, like we said prior, and there's rising competition in now. So if we look at this graph that we made, it kind of puts it into perspective. If you look at the yellowish line, that shows the dividends paid, and then the blue line is the retained earnings. You can see once we hit 1992, the dividends paid keeps going on a gradual increase, but the retained earnings go on a straight decline and then kind of gradually stay the same. If you look at 1993 alone, we're north of $450 million in dividends paid, but there's less than $100 million in retained earnings. This causes stress and trouble for the company itself, because if something happens, they only have $50 million to work with, while they gave out $450 plus million, and you can see why that would be an issue going on in the future. So when it comes to the dividends and how to solve this, you got to look at the investor composition. This plays a very big crucial part, and I'll explain all of this. So FPL is made up of 58% of individual investors. These are particularly retirees that seek value and steady dividend streams. That's why they really look forward to FPL, because the dividend is so high and they're just continuously investing money, and they're going to keep getting that steady dividend stream, and money's just going to keep coming in. And then we got 33% of it as corporations. It's a little bit lower than individual investors because they're only partially tax exempt, and most of them or some prefer reinvestment into capital appreciations because they can make more money, and like I said earlier, they're only partially tax exempt. Nonprofits are 9%. It's 9% because they don't pay taxes, so they prefer steady income like dividends, which is, you may say the 9% seems a little low, but you got to think about it. Individual investors, there's so many more than nonprofits. So that percentage is going to be lower, but a lot of those nonprofits do look for high dividend yield companies like FPL. And main challenge with this is balance. If you're going to make a move with your dividends or make a move with the company, you got to look at your investor composition to make sure you're not going to do something that 58% is going to drop down to 40. You don't want to do that because that's more than half of your composition. So you really got to put in your back of your mind, what are you going to do? How's it going to reflect on your investor composition, and if it's going to be positive or negative? So the market and the competition. There's been deregulation recently, and that's caused for rising competition, which FPL is facing currently. And there's also rising interest rates, which mean higher costs. Additionally, FPL stock falls 9.6% since 1993. So to put this into perspective, why the stock fell. One, because there's deregulation, rising competition. People are going to switch to a cheaper option. So people switch, people invest in something else, the stock falls. The interest rates mean higher costs. This also just means since their retained earnings are so low, like we showed prior with the graph, those higher costs are all their retained earnings are going to be spent. They're going to have no money left over. The company's not going to grow, and it's not going to reinvest in itself because there's just not going to be much more money left over with all the higher costs. And I'll get into that later. So my recommendation, if I'm an investor, I'm hold on to the FPL stock. That 90% dividend payout ratio, it's not going to go up anymore. They might freeze it or it might go slightly down. That's still very good yield. And they've proven themselves over time that they're strong and reliable, especially for the long run. If you invest in the FPL stock, you're not looking for a 1 year skyrocket of 20%. You're looking to reinvest in over gradual 30, 40 years. You're going to look back at that, see all your dividend yields, and be like, wow, it panned out pretty well for me. And then if I'm recommending anything to FPL, they need to freeze or reduce their dividend growth. Because right now it's just unsustainable what they're doing with all the rising costs and competition. If they keep going up that steady increase of the dividends, they're going to run and they're going to basically have no retained earnings. And they're just digging themselves in a hole, and this is going to keep getting deeper, and deeper. Once they freeze or reduce their dividend growth, they got to invest their earnings in the modernization. They got to keep growing their company, show that they're better than everybody else, cut costs maybe, and then that will prove to everybody, oh, we should keep going with FPL, and their stock will rise just from doing that alone. Key takeaways that everybody needs to take away from this presentation is that the payout ratio is unsustainable. We discussed this earlier. I'm sure you guys understand it by now, but if they keep going up that hill, they're just going to dig themselves in a hole. The dividend freeze will preserve risk, and it needs to happen because they need money to be able to operate and grow. The diverse investor base is very, very important for what decisions they make. And that's why I think freezing it is the best option, because it's still high dividend yield. They're not lowering it drastically to make all those investors look like, oh, what are we doing? I got to switch to somebody else. I got to look for a different company. Freezing it, you still keep it higher than all of your competition practically, and you get to reinvest into your company. And FPL still remains a very strong company that needs to be known. Everybody should know that because, well, we all use it. So FPL is fine. But if they do all these key takeaways, I think FPL will have great success and we'd see great things in the future. Thank you guys for listening, and hope everybody has a great rest of your day.